Welcome back. You're still tuned into Power Breakfast, and let's talk about some of the individual stocks which could be in focus today. The big one is going to be automaker Tata Motors after it reported a very weak set of second quarter earnings. So Sonia's here with the details. Sonia, good morning. What really went wrong for the company?
So, if you look at it on a year-on-year basis, right, the losses for the company have narrowed, but it was expected to be a much better quarter. So, compared to estimates, the numbers were much below, and I think that's where the disappointment stems from. It's a net loss of about 940 crores. The poll was suggesting a profit of somewhere around 250 odd crores. Even on the EBITDA front, overall, the consensus EBITDA was expected to be about 8,300 crores. It came in at 5,572 crores. Now, if you just look at the JLR numbers, right, the EBITDA margin at 10.3% is a fall of 230 basis points compared to what we saw last quarter. Not just that, JLR has also reported a negative free cash flow of 15 million pounds because of the adverse working capital movement. Now, if you just look at the core numbers, the consolidated numbers, they don't look that bad year on year because of the low base of last year. So revenues are up about 30-odd%, EBITDA up 35%, the margins improved to 7% versus 6.6%, and the net loss is much lower than what we saw same time last year. But it's not comparable because same time last year you had severe semiconductor shortages because of which production itself was on the lower side. The big concern for me is the rise in net debt for Tata Motors. So this time around the net debt has almost ballooned to 60,000 crores compared to 48,700 crores at the end of FY22. And the management says that this is because of working capital deterioration as well as weak profitability that hurt the cash flow at JLR. They also sound a bit cautiously optimistic in their tone when they say that the demand is strong, but the global challenges make it a bit of a monitorable, so they are not quite sure whether this demand can sustain. JLR has an order backlog of 205,000 units, and they're expecting to see an improvement in the second half of the year as the chip supply improves. Now, one more reason why the stock could be under pressure is because JLR has lowered its guidance for the full year because of the global challenges. They now say that the EBIT margin will be positive, but earlier they had said that they'll do a 5% EBIT margin. That's what they said in Q1. But now they're just giving a blanket statement saying that it will be positive. Also, they're expecting a free cash flow break-even in FY23. Back to you.
All right, Sonia, thanks a lot for taking us through all of the numbers as well as what the management is